Cece. Welcome to the Orbit. It is Tuesday, April 16th. We've got stocks flat today, about 40 minutes into the trading day. We've been up and down a little bit, opened higher in the green, pulled back, went in the red a little bit. Basically unchanged right now. It's sort of an odd open, to be honest. After the last 2 days, you would expect, I think traders would root, bulls at least, would root for some sort of flush in the morning that then takes everybody out, gets washed out, and then you start a rally back higher. Of course, bears like to see a green open in this trend, sell into it, and then watch it fail and go down lower. We have seen neither. We've sort of gone sideways. Look at the IV today in 0DTE. We were looking at 36 IV. That's even higher than yesterday. And we've got a 0.7% expected move for the rest of the day. Going out a week, we've got a 1.5% expected move for the rest of the week at about 21 IV. And those numbers are basically 0DT is ticking up from an expected move perspective. And the weekly expected move is staying the same, which means IV needs to increase to hold that expected move at 1.5. Let's go into the 0DTE and check out some iron condor levels. This is the expected move, 50-30, 50-95 to the upside. Obviously, that's only about 30 some points, 32 points in either direction. And that yesterday would have been way too tight. So with the market basically flat today, and you're looking at this iron condor with implied volatility this early in the morning and a big fat expected move. But you also want to see what this market does. I mean, if this were to fail and you went down to 5,000, perhaps you use that not to sell the 5,000 level, but to perhaps get something, 40 points below the 5,000 level. If you are doing a straight neutral trade, let's take it wide and see how wide we can get. And this is sort of that inflated expected move and that high vol. How wide can we go before we hit that 4-to-1 risk reward? And here we are. We're at the short put at the 5,005 level and the short call at the 5120 level. And options premium is so high that in near term, with the 35 IV today, that you are getting basically 4-to-1 risk reward. And you have about 60 points in either direction on SPX. We've had a couple of days of red, down a few percentage points, and we haven't seen that in a while, so it sort of feels a little shocking. But when you look at the longer term picture, we are only about 4% from the highs. If you took SPX down to 5,000, that number, you would be down about 5% from the highs, so that's not much of a move. So if we saw the VIX, if we saw the SPX go to 5,000, and we saw a VIX spike up into the 20s, that tends to be a buying opportunity more times than not. The times that it is not in the market is where it becomes a big thing. It's a much bigger crisis, like what we saw last fall with the interest rate worries. Is we saw about a 10% correction. Type of move in the market is enough to get the VIX up towards, say, 30 or something. And those are the days, at 30 VIX, those are the days where you kind of have to worry about a 3-4% move in the market. But a 21 or a 22 VIX, historically, and especially over the last couple of years, that has tended to mark a buyable bottom, even just temporarily in the market. So keep an eye on the VIX, keep an eye on yields, keep an eye on IWM, and that moment where you see that sort of washout and that VIX spike into the 20s might be a temporary moment where you get that sort of washout and the chance for a quick return up a couple of percent in the market, a tradable bottom. At least temporarily. And, of course, volatility is going to be high at that moment. Credit put spreads, even at the money credit put spreads, take advantage a lot of that high premium, in a stock you like or in the market or something at that moment with the VIX, 22, 23, and that will quickly collapse on a little bit of a rally. And it's the type of trade where if you have defined risk and you are wrong and the market continues lower and the VIX goes to 30 something, it actually helps that trade a little bit as you go a little lower, because that high volatility allows you to take that being wrong credit put spread at the money credit put spread, let's say, or just out of the money credit put spread. It allows you to take that off for less of a loss than if you were at low volatility and it was basically, it just went in the money and it close to 100 deltas immediately. In this case, because we're looking at the SPY right now, if the SPY got down to 500 and you saw the VIX spike up to 21 or 22 today, and you sold, what would that at that point be an at the money credit put spread, almost 1-to-1 or just under 1-to-1. Maybe let's call it risking less than 300 to make a little bit more than 200. At that moment, if the SPY just blew right through 5,000 to the downside and went down to, say, 497 and a half, your credit put spread will be at a loss mark to market, but not that much of a loss, because volatility will be so inflated that it'll basically be giving that credit put spread 50% odds of finishing completely in the money or completely out of the money at that point. And that's what happens when you're selling premium and then it goes in the money. The spiking vol actually helps you a little bit because it lessens the losses. Now, if volatility is high as it bounces and stays high, it can be annoying on a credit put spread because it kind of holds that value. You don't get that collapse, you don't get that theta immediately, because implied volatility is still putting your credit put spread at a really high chance of going in the money at some point. But mostly, if you catch a bottom and a VIX spike and a vol spike, and you do it via a credit put spread at the lows or near the lows, volatility will help you, because if you bounce, volatility will collapse. You might be able to take that credit put spread off for a quick gain that is largely IV, not just delta. And if you're wrong and your timing is wrong, that high IV will keep going higher and will actually lessen your losses a little bit.